Today might be the best opportunity for you to invest in the stock market. First of all, I do want to apologize for my lack of uploads over the past couple of weeks, but now I'm back on track to cover some of the latest developments in the stock market, some of my investments, and the electric vehicle space. And well, I think it's safe to say that there have been some pretty significant developments. The FOMC meeting just showed us that the Fed is still on track to raise interest rates ahead of their pausing at the end of this year. And we have heard Apple release fantastic earnings, and stocks like Coinbase and Meta release fabulous beats. And well, why does all this matter? Because the earnings recession many people had predicted is not coming, and the stock market continues to roar higher. In this video, I want to explain why everybody got this so wrong and how the positioning of hedge funds and institutional investors is creating a unique opportunity for retail investors to take advantage of. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit the subscribe button if you haven't already. So to start things off, folks, let's address the elephant in the room in what Jerome Powell said on Wednesday. Pretty much, he repeated the same narrative, where he wants to raise interest rates to bring down inflation, even though headline CPI has fallen from 9% to 5.5%. The trajectory is pretty clear, but as I've said countless times in the past, at this point, this is more of a political campaign ahead of next year's election. Jerome Powell simply does not want to be associated with runaway inflation, and as a result, he wants to stick to this narrative that he obviously already got wrong throughout 2021. And well, in doing so, he has now raised interest rates to the highest level since October 2007. In some cases, on something like the 2-year Treasury yield, levels are seen as high as 2006, right before the great financial crisis. Now, I know what you're thinking. This might be the sign for people to get out of their positions, as we all know what happened during the great financial crisis and even the tech and telecom bubble of 2001. But before you make those kinds of decisions, I want to share exactly why today is not the same as then. And well, it has all to do with the idea that today in 2023, we are dealing with two problems, inflation and a banking crisis, that are actually going to neutralize each other to create a softer landing for the economy than many people think. As a matter of fact, we just got the April jobs report with payroll information and the unemployment rate, which for the 13th consecutive month came in much better than most analysts expected. This is a crazy run of expectation beats. It is pretty clear that the economy is performing much better than what the financial banking crisis or the tech sector in the stock market might portray. And if you look at the simple data for the past 30 or so years, it's really easy to see why there is such a correlation. As you can see, if you go back to 2008 and 2001, which is what most investors focus on, yes, after the Fed started cutting rates is when we saw the recession and EPS declines in the S&P 500, like we can see here on the yellow line. But if you go to a time when we actually saw economic growth and no fundamental reason for the Fed to be raising rates, like in the early 1990s, then as you can see, whenever the blue line came down, which is when the Fed started cutting rates, S&P 500 yields did not actually go back down. And as you all probably know, in the early 1990s, the only reason the Fed was raising rates was to slow down the economy purposefully. It was to obviously slow down inflation, which was a result of the Great Moderation, which was a policy the Fed put in the 1980s. And as you can clearly see, that was an exception to this rule around interest rate cuts timing with massive recessions. And another big differentiator this time around is that analysts and Wall Street have been talking about this recession for a much longer time than we did in 2001 or 2008. As you can see, it's been 13 consecutive months of better than expected non-farm payroll reports, which we have not seen throughout the entirety of the 21st century. And well, I hate to break it to you, but this time around, this idea of the wage price spiral has also gone completely out of the window. This was a big talking point of 2022 because obviously higher wages would result in more inflation, and more inflation would result in higher wages. And that was what the Fed was trying to avoid. But clearly by the data that has come out since the start of this year, where job cut mentions have finally surpassed labor shortages, it seems like that problem is in the rear view mirror. As a matter of fact, the market disbelieves what the Fed is doing so much that after they raised the rates on Wednesday, the terminal Fed funds rate projections from S&P 500 futures actually steepened to the downside, as you can see in blue. Just 2 days ago, they were in yellow, and now they are in blue, where we're expected to see 3.8% by March of 2024. The market is essentially telling us that the Fed is doing this all wrong and that at some point they're going to have to cut very aggressively. Obviously, these predictions are not set in stone. This is just what traders and speculators are pricing in, but it goes to show you that the consensus still believes all of a sudden that the Fed is not doing the right thing, which is what I tend to agree with as well. And what this has resulted in is a historic net short position from most leveraged funds on the S&P 500. If you look at the E-mini common futures, they are now down to almost negative $344 million, whereas negative US Treasury shorts are down to negative $1.23 million, below the levels we saw in 2019. In summary, this is basically an estimation of the market expecting rates to be cut aggressively, and as a result, on the top, people pricing in that markets will also go down. But as you can clearly see, there is a very little correlation between the blue chart and the yellow chart. But guess what the good news is? We'll know whether or not the Fed is doing the right thing on May 10th, which is when the April CPI report comes out. As of right now, Jerome Powell still expects us to see modest growth for 2023 and a mild recession at the end of this year. Based on the most recent GDP report, it doesn't seem like we're going to go into 2 consecutive quarters of negative decline so far, but things could obviously change. And as for how markets are going to perform during this time, it's very difficult to predict because right now we're seeing a divergence between large cap stocks and small cap stocks tracked by the iShares Russell ETF, which as you can see is down almost 3% over the past 6 months, while the NASDAQ is up almost 21%. At some point, this divergence will close just like it did in 2016 and 2020. And as a result, this is creating a good investment opportunity for somebody like myself who likes to dollar cost average not only into index funds, but also some of my most speculative and favorite growth stocks. So far, this earnings season has been fantastic, but we still have many companies to report next week, so I'll be waiting to cover them as soon as I can. As usual, guys, let me know your thoughts down in the comment section below as to whether or not we are going to see a decline in markets within the next 6 months, or whether or not the Fed should even consider pausing. Let me know your thoughts down in the comments, and I'll catch you guys in the next one. Take care.